Happy Thanksgiving. Ivan here with Isla Vancouver Wealth Management. Financial advisors spend a lot of time talking about risk to their clients. The word risk means different things to different people. To some it means I will lose it all, or I will get hurt. To some it means gambling. In investing, it often implies volatility, your investment going up and down over a period of time. So today I would like to explore what exactly are we talking about when we talk about risk. Let's check it out. Let's look at this great little piece by my friends at Fidelity explaining what's involved in investment risk. There's two main components: risk tolerance and risk capacity. Risk tolerance is how much risk you're willing to take, which may potentially impact the future reward. And again, what we mean volatility. When we say risk, we mean volatility. How much up and down in your portfolio are you willing to take? Risk capacity might be different, is how much risk you can take. Your circumstances, your age, your income, all may determine how much risk capacity you have. Investments that have the potential to earn bigger returns also often have more risk. Stocks, they may be more volatile. They go up and down more than bonds, although as we saw in 2022, both stocks and bonds went down together. That was an unusual time. Cash is usually safer because it doesn't go up and down. It also doesn't earn much. Every investment type has their own risks. For stocks, the risk could be you could be too concentrated into one stock, and each individual stock faces risks of how is the company managed, or a headline in the news that could change its market value. With bonds, what interest rate environment or what economic environment or the credit quality of the bond issuer would make the prices go up and down. Even cash has some risk. Inflation. If you're earning less than what the inflation rate is, your purchasing power will decrease over time. Warren Buffett once said, the important thing is to know what you know and know what you don't know. Here are some examples of how risk tolerance can influence your investment strategy. An aggressive investor is willing to use high risk in the quest for higher returns, but that comes with volatility. An aggressive investor needs to be prepared for lots of volatility. A moderate investor would be willing to take some risk, but would want to have a portfolio that's balanced, that has some low risk securities with some higher risk securities. And a conservative investor is willing to accept lower returns, but rather have safety of their capital, not to see that much volatility. Some investors don't want any volatility, and for them, the options are limited to maybe cash and guaranteed investments like GICs. So when it comes to risk, it's a personal decision. Only you can determine what risk you're willing to take with the help of your financial advisor. Everyone's risk tolerance and goals are different. I will add that for the same investor, there may be two different goals with different risk tolerance. For example, you may be saving to buy a house or a car within the next few months. That would be a low risk investment goal. You cannot take any volatility. But you may also have a long-term goal, such as retirement or moving to a different country many years from now, an education for a child that was just born. Those are longer-term goals where you could potentially take a higher risk. Talk to your financial advisor. Don't forget to subscribe, and I will see you next time.